what they aren't talking about, everyone says it's to pay down the debt. To me, it's bigger than that. It's to be able to have an inkling of a chance to start to sell your manufacturing to the globe. It would be one of the first steps. Now, you could argue that it's premature to do it before you bring your manufacturing back, but I don't know if there is a plan or a strategy on how you do this. It seems to me that the best way to do it will be to let gold and silver move up organically for a while and then maybe revalue it at some point. But I do think that's what they're doing, and they're in your face with it now by taking these positions in companies like this. There's no question about it. I think you'll see more and more of it.
Right now, on November 24th, 2025, something is happening in the global financial system that we have never seen in recorded history. Gold recently touched the 4,050 to 4,100 range, and silver continues holding strength near 49 to 50, even as the US dollar remains strong and rate cut speculation continues. These price movements aren't random volatility. They are signals. Behind the charts, governments, institutions, and sovereign wealth capital are rapidly accumulating hard assets, not just futures or ETFs. Andy Schectman believes this marks the beginning of a global shift, away from a financial system built on debt, leverage, and trust, and back toward a system built on real physical value.
I think they have gone from doing everything they can to delegitimize gold and silver to making it far more in-your-face overt. Of course, you know that the U.S. just reclassified silver as a critical mineral, amongst many others, and the amount of gold and silver that have been brought into the COMEX since last November is off the charts, and somewhere in the neighborhood of 200 million. But there are reports that just came out in the Financial Times that said that governments around the world are reporting roughly 1/3 of their official buying, down from about 90% 4 years ago. That's according to the World Gold Council. And then China, which is the world's largest producer and consumer of gold and the second largest of silver, certainly not being transparent how much they own, 10 times, they assume, more than what they are reporting. And they're also, they just came out and said they're going to limit exports. They're going to tighten silver exports. This is a race, if you will, to accumulate physical metal. And I think the government understands that, not just physical metal, all critical elements. And I think it's no longer about promises from a broke country, in other words, taking our treasuries, and more about who's got the real stuff. You can see this in the amount of deliveries coming off of all of the world's exchanges. You can see this in how the people that are importing hundreds of billions of dollars of metal into the United States are the most, not just the most well-funded traders here in North America, if not the world, they're the most well-informed. But that goes hand in hand with what the central banks have been doing. The first podcast I did with you years ago, that was probably front and center what we talked about, how the central banks have been buying gold. Here you have and silver and other commodities, that you have the most well-informed traders in the world showing you what they are doing. And it's gotten to the point now where there's no reason hiding it any longer. And in particular, if you do want to debase or devalue the dollar, you do it in raising the price of all of the world's commodities, because we've become too accustomed to measuring the currency against a basket of crap currencies, the dollar index. It's not how you should do it. Dollar is down 8 or 9% against the dollar index, mostly the euro, but it's down 70% against silver, 65 or so percent against gold. And so I think it's come to the point where perhaps they do want to debase the currency. Even mainstream media is talking about it now, that it's not a hidden agenda. To me, what they aren't talking about, everyone says it's to pay down the debt. To me, it's bigger than that. It's to be able to have an inkling of a chance to start to sell your manufacturing to the globe. It would be one of the first steps. Now, you could argue that it's premature to do it before you bring your manufacturing back, but I don't know if there is a plan or a strategy on how you do this. It seems to me that the best way to do it will be to let gold and silver move up organically for a while and then maybe revalue it at some point. But I do think that's what they're doing, and they're in your face with it now by taking these positions in companies like this. There's no question about it. I think you'll see more and more of it. It's never really a great deal when you have the government in private enterprise, but I do think it goes to show the desperation of a country that realizes that these items are critical, and we are way behind the eight ball in accumulating them, in refining them. You know, it's not just the accumulation. China is responsible for the refining of 90+% of all the world's rare earths. So it's not just in pulling it out of the ground, it's refining it. And it's interesting. You look at a country like China, which is the second largest producer of silver in the world. They tell David Morgan when he went there, no, we're number one. They're either one or two. They're arguably number one in gold. Now, you talk to Sean Kunkun, who you know, the CEO of Dolly Varden, and he'll say to you, stupid cord, he'll say to you, yeah, Andy, China is flying all around South America, in particular Peru. You mentioned deep water ports. China just built a deep water port there. The Belt Road Initiative is building things like deep water ports, rails, maritime channels, bridges, gold and silver mines, oil refinery. They're building it all within this ecosystem and then helping get it to market. Well, they're going to Peru and to Mexico, buying it in doré and concentrate form before it's even called silver or gold, and shipping it back to China where they refine it themselves. There is a rush to get the stuff. And thank God, in my opinion, somebody got to Trump, because all of this started in terms of importing into the U.S. somewhere around November of last year when he won the election. There is no question in my mind that someone got to him and said, we are losing the race. The last administration really put us behind the eight ball. We need to do this right now. And I think that's what this is all about. So to your point, yes, it's not really normal. It's somewhat surprising at first glance, but to me, it really isn't. And I think it's a necessity. The drawback, the side effect would be universal basic income for a while. I do. And I think the selling piece is, look, we screwed up a good deal. The world has been our creditor. We've had low price goods. The recycling of their money into treasuries has given us low interest rates and high asset prices. But the problem is the rubber is meeting the road right now. Foreigners used to load up on U.S. treasuries back when America looked stable and risk-free, but not anymore. And with $38 trillion in debt before unfunded liabilities, with $500 billion added in just the last 6 weeks, foreign governments are losing faith. They're dumping dollars. They're diversifying into gold at record pace. And that's the point. Record U.S. debt is driving record gold demand. It's driving people out of the treasuries. And until Washington gets really serious about fiscal discipline, this won't stop. And they're not going to. So I think this is the path, is that you must bring back manufacturing at all costs, no matter what. If you don't, our future generations are in serious, serious trouble. And AI is taking away and robotics and automation. That'll take place a lot of the jobs they bring back in manufacturing. But we still must do this. If not, you can't be reliant on pharmaceuticals, from aspirin to penicillin, on machine parts, on aircraft parts, on military components. You can't be reliant upon what in essence is almost our foes across the globe to provide this to this country, especially when we are as indebted as we are. And we can't expect that countries will want to continue to take our treasuries when we are as fiscally irresponsible as we are. So this provides synthetic demand. And on the back end, the gold says, okay, fine, we don't want your dollars. And the more stupid you are with fiscal irresponsibility, the higher the price of gold will go. That is the interest rate that they tag on to the back end of the long bond, because it will be denominated and redeemable in gold. So there is no perfect answer, but it's like Andy Dufresne in the Shawshank Redemption. He had to crawl through 2 miles of crap to get to the other end. And when he got to the other end, he stood like this and he made it. Well, there is hope at the other end. And I think no matter what, we have to find a way to bring back manufacturing. To me, this is the only way, really, while you still can find demand for your treasuries, both synthetic and real.
According to Andy Schectman, we're no longer dealing with a normal metals cycle. We're watching a strategic repositioning of global power. And the proof isn't just in government policy, It's in what's being accumulated, who's buying it, and where the metal is going. Since late last year, physical gold and silver deliveries have surged, with large volumes being withdrawn from COMEX and LBMA vaults. What makes this unusual is that most of these withdrawals are happening through private settlement and institutional delivery, not retail speculation. Meanwhile, the U.S. Department of Interior's decision to classify silver as a critical mineral reflects a changing mindset. Metals are now seen as strategic assets tied to national security, manufacturing, defense, and energy independence, not merely investments. On the global stage, key producing nations are tightening export controls. Refining bottlenecks are increasing. Major mining companies are receiving government attention, support, and in some cases, ownership. Something Andy Schectman calls a desperation move by countries that woke up late and realized they were losing access to the world's resource base. Retail investors today are highly leveraged into stocks, options, and speculative tech, even as risk indicators flash red. Margin exposure is at record highs, yet insiders, billionaires, tech executives, and institutional asset managers are quietly exiting equities and building defensive positions in cash and metals. For the first time in modern financial history, major institutional strategists are openly recommending 20 to 25% gold exposure, something unheard of during previous bull markets. To Andy, this is one of the biggest confirmations that the shift is real, because those at the top don't make changes like this unless they know what comes next. The current price action, steady strength while mainstream media barely acknowledges what's happening, is typical of early-stage monetary transformation, a phase where the informed accumulate quietly before the public wakes up and the chase begins. Schectman's message to investors is simple. This isn't a trade, it's preparation. Gold and silver are no longer just hedges. They are becoming the measuring sticks of value as confidence in fiat currency models continues to erode.
I might get nervous.
Right.
The retail market, when you realize that the mom and pop investor is all in the equity market, largest representation ever, about 55%. They are all in on option purchases, the largest amount of option play ever in the history of the market, and they are all in on margin, the largest margin exposure ever, 1.4 trillion. They are all in. At the same time, you see guys like Buffett sitting on 500 billion in cash. You see Bezos selling 6 or 7 billion worth of Amazon. You see a lot of the people divesting out of Nvidia and moving to cash. Not a good sign. But what gives me what I think, and you don't hear this anywhere, right? Nowhere. You may hear on Fox News, oh, gold, and you see the ticker. Oh, yeah, it's probably the top. No, it's not. Because what you are hearing, if you look closely, is something I've never seen before, ever. 3 examples. Number 1, the chief investment officer of Morgan Stanley says, sell half your bonds and put 20% of your assets in gold. What did he just say? These are the guys that maybe would have said 5% and probably not even. Sell half of your bonds and buy gold. He said it's no longer the 60-40 platform that Wall Street's used for 50 years. 60% stock, 40% bond. No, make it 60-20-20, 20% stock. Michael Hartnett, the chief analyst at Bank of America, his newsletter is a fortune. Thousands and thousands of dollars a year. It goes to the institutional traders. He says, no, 25, 25, 25, 25. So have 25% stock, 25% bond, 25% short-term treasury, 25% gold. And maybe the craziest of all is the bond king, Jeffrey Gundlach. He says a 25% allocation in gold is not overweight. Now, these 3 guys, Chief Investment Officer Michael Hartnett and Gundlach, they're not speaking to the plebes. And the plebes are all of us. They're speaking to the institutional traders up at the top. They're speaking to the people who have brought in hundreds of billions of dollars of metal into COMEX since last November. Billions and billions and billions every month. Who the hell is it? Not a word on who it is. No one knows who it is. I have guesses, but who is it? That's who they're speaking to. So to your point, yeah, Jim Cramer talking about gold, run. CNBC and Fox, take it with a grain of salt. When these guys are talking, it's insane. And I will tell you that the level of business that we have, and we'll do a lot of 700-800 million in sales this year, a lot. That's mostly from much larger orders. Our average order size is getting pretty well near six figures. Not always. We work with all size clients, but you're seeing way more and way more seven-figure orders. But we're not seeing the tremendous flow that we saw during Silver Squeeze when everyone put even $1,000 into gold, silver, whatever they could get. 2,000 orders a day. Now it's 200 orders a day, but much, much larger from people who are paying attention. So no, the public is far away. They're all in on equities, on margin, and on leverage. As the insiders, whoever the hell they are the most well-informed traders in the world who are standing for delivery on COMEX and draining the LBMA. They know what's coming. These people don't do things just for the hell of it at that level. They know the inside playbook, if you will. And that to me is what gives me comfort. Not only are the top analysts saying buy gold 20, 25%, what do they really think? But whoever is importing this kind of quantity in gold and silver into COMEX, you have to say to yourself, these people at that level, they know what's going on and they are preemptively preparing when the public is just blissfully whistling Dixie into the stock market on leverage and on margin. What could possibly go wrong? So I think before it's all said and done, maybe this year, maybe next, you'll be standing room only and people will have to fight for tickets like it's the Rolling Stones farewell tour, let's hope, right? I would argue that there is basically no independence with the Fed, none. I mean, it's funny too because Goldman Sachs says, if the market fears that the Fed has lost independence, you'll see gold at $5,000 very quickly. Well, when you have the architect of the Mar-a-Lago Accord, Stephen Meyer, and fill one of the vacated spots at the Fed, who was Trump's advisor, what independence? There is no independence. And all of the people that you see leaving, there's another one who was just flagged for impropriety with trading. I forgot her name. This just came out a couple of days ago, but she was trading stocks that she shouldn't have been when she shouldn't have been. She's going to be gone too. You're filling these positions with people who I think Trump is hand selecting. And so therefore, what independence? There is no independence. Perhaps Powell is the last piece of pushback, but I think you are beginning to lose independence quite substantially. And as far as what the Fed is doing, I would argue right now something just happened that I think people need to be aware of. Nomi Prince did a great job in writing about it. And something is happening beneath the surface of the financial system, no question about it. And that's the thing that right now I think people need to pay attention to. And it's hard to pay attention because it's not really in your face. The mainstream media doesn't report on any of this. And you're, of all the people I interview with, you are top one or two most well-informed. Now, I don't know if it's because you do so many interviews or because you're like me and read 3-4 hours a day to understand what's happening. But you always have pushback, and the questions you ask me are always well-informed. But you won't find any of this stuff on the mainstream. What I'm getting at is over a 5-day stretch over the last 2 weeks, the Federal Reserve, which has been talking about ending QT and maybe going back to QE and lowering rates, but what they did when no one was looking is they injected $125 billion into the repo market. And they call it in an effort to ease funding stress, right? Which I don't believe, and I'll tell you why in a second. First of all, an injection of that kind of money, $125 billion in a few days, is crisis-like behavior. And it's pretty much on par with what we would have saw when Lehman Brothers collapsed in the great financial crisis in 2018, and almost exactly what we saw during the 2019 repo blowout where the overnight lending rates went up over 10%. First of all, for people to understand, the repo market is the plumbing of the financial system. It's where banks lend to each other literally overnight. And this keeps everything flowing. Normally, this market is quiet, and that means everything is working. You never hear about it. But when the Fed suddenly steps in with huge amounts of cash, it's the equivalent of hearing a loud banging noise inside your walls whenever you turn the water on. Something isn't flowing right. But what makes all of this really concerning to me, Jay, which is so different than the 2019 issue and the 2008 issue, in both of those issues, they call it a liquidity problem, right? The banks didn't have enough money and they needed liquidity. The Fed had to come in and provide liquidity. And that's exactly what we saw back then.
So here's the real question. Do you believe gold and silver are simply rising, or are they being positioned to anchor the next phase of the global monetary system? If this breakdown helped you see the bigger picture, then tap like, comment. Your thoughts, subscribe, and turn on notifications. Because this story isn't slowing down, and the next chapter may arrive faster than anyone expects.